All right, welcome back to the Double Play channel where I show you how you can put your money to work in two places at one time by leveraging the cash value of a maximum overfunded life insurance policy. And today we're going to be talking about a topic that you're likely to come across as you're doing due diligence into life insurance and real estate investing, particularly leveraging life insurance to invest in real estate. And that is people who say life insurance is not an investment. Or alternatively, they may say, keep your life insurance and your investments separate. And the point I want to make in today's presentation is that it doesn't matter what you call it. If it furthers your investment objectives, then a maximum overfunded life insurance policy should be part of your financial planning toolbox. So if this is something that you're interested in learning about, stick around after the intro and we'll get started. Hi, I'm tomrutkowski with Innovative Retirement Strategies. Thanks for sticking around. I discovered the concept of the double play on my own many years ago, and it's so powerful that I really wanted to share it with the world. And the goal of this channel is to teach you how you can leverage the cash value of a maximum overfunded life insurance policy to invest in real estate. And along the way, we're going to debunk some of the myths and misconceptions about life insurance. But what I really want to do is use facts and data to debunk all the hype and BS that you'll find on a lot of other sites. So today's topic, again, we're going to be talking about people who say life insurance is not an investment, or keep your insurance and your investments separate. And again, in my opinion, it doesn't matter what you call it, so long as if it furthers your investment objectives, then it's something that you should include in your financial planning toolkit. So before we get started, let me take care of a few housekeeping items. First off, there is no rendering of advice, no tax advice, no financial advice. This content is purely educational. And secondly, the primary reason to purchase life insurance is for the death benefit protection. Any other benefit is purely ancillary. If you find my content valuable, please like this video and subscribe to the channel so that you're notified whenever I come out with new videos. All right, so the way I'm going to break this down today is in three sections. One is I want to deal with the presupposition that life insurance is something different from an investment. And secondly, let's define what the goal of your investments is. And then finally, presupposing that I've already showed you that life insurance is a valuable tool that you should include in your financial planning, then what are some of the key advantages of a maximum overfunded life insurance policy for your financial planning? So let's get started. All right, so let's start with the presupposition that life insurance is something different. It is. Yeah. In most cases, for most people are buying life insurance for the death benefit protection, and they're going to do that with either term or permanent life insurance. But for most people, they're trying to keep the price of their death benefit protection to an absolute minimum. And it's important to understand that a maximum overfunded life insurance policy is something completely different. It's a policy where the goal is not death benefit protection. We're actually trying to reduce the death benefit protection to the absolute lowest amount that still meets the definition of life insurance from a regulatory and statutory perspective, but is as close to being an investment as it can possibly be, without violating that rule. All right, so next we want to talk about the purpose of your investments. And first and foremost, I think most people are saving for retirement or investing towards retirement. And that's the one that I want to focus on most today because that is my business, Innovative Retirement Strategies. But people do have other goals for their investments. They might be saving for a child's education. They might be saving to give to charity if they don't have any kids. But the point I kind of want to get across to you is you can't take it with you. So either you're spending it today or you're saving it for a reason. So what is that reason? And again, charity and wealth accumulation, estate planning, all those things I'm going to leave to other people, but I really want to focus on life insurance as a retirement planning asset today. So let's talk about retirement planning. A life insurance retirement plan should generate about 2 to 3 times the income that you can get from more traditional types of retirement savings, like a Roth IRA, a traditional IRA, or just money sitting in a brokerage account or a 401k. And then also, I would state that anybody over the age of about 30, dollar for dollar, should get more retirement income from putting money into a life insurance retirement plan than they would by contributing to a 401k, an IRA, or just putting money into savings. Now, if you're getting a company match, that's a little bit different story because that's an immediate 50%, 100% return on your investments. So that I'm talking about just dollar for dollar of your own money. The life insurance retirement plan should generate more retirement income. All right, so where am I coming up with this number of 2 to 3 times the income? Most financial advisors use the 4% rule for determining how much income you can safely take from your investments without risking running out of money before you pass away. And don't take my word for it. After this video is done, go out and Google 4% rule. Write it down right now. Don't take my word for it. The 4% rule is, again, the safe withdrawal rate that you can take from your retirement savings without risking running out of money before you pass away. So 4%. So if you've got $1 million of savings, what the 4% rule is stating is that you can safely take about $40,000 a year from your retirement savings without risking running out of money before you pass away. Well, if that money is sitting in an IRA or a 401k where it hasn't been taxed yet, remember, distributions from a traditional IRA are taxed at ordinary income tax rates. So if you take $40,000 from savings of $1 million and you're in the 25% tax bracket, you're going to end up with about $30,000 a year after tax. And as I'm going to show you here in a minute, when we look at a real illustration, life insurance is capable of generating about 8% income. And that's the magic of leverage, taking policy loans and still having the cash in the account growing and earning interest. So the safe withdrawal rate, and again, I'm going to show you this, is about 7 to 8% for a life insurance retirement plan. And that money is coming to you tax-free. So if you had $1 million of cash value, you could take about $80,000 a year of after-tax, tax-free income. Compared to the $30,000 from the example I just gave you, you can see that that's between 2 and 3 times the after-tax income. So that, again, assumes that you've got equal amounts of money. But people always say, well, I can grow my money faster in some other asset class. Well, it would have to grow at 2 to 3 times the rate, right? It would take $2 million of savings to generate the same income as $1 million of cash value. So, is it really going to grow that fast? And that's where the second bullet point comes here, is that even for a 30-year-old, they should get more tax-free income because it's unlikely that their savings is going to grow enough to overcome that benefit from the life insurance. So again, if you know me and know my videos, I don't like to just talk about these things. I like to show you the numbers. So let's take a look at some real numbers here. All right, so what we're looking at here is a life insurance illustration that I did for a recent client of mine. And what I'm highlighting here is the policy loan income is $128,000 a year. And you can't see it here, but that income is being run out all the way through age 120. So it would be impossible for this person to exhaust all of their collateral by taking loans before they die. The other thing that I want you to take note of is there's 2 investment scenarios here. One is assuming a worst case scenario of 3.5% growth, but the income calculations are not based on that. We're looking at the rows labeled using illustrated crediting rates and current charges. That's the actual growth as projected here. And the assumptions I'm using here is this cash value is the cash value itself is growing at 5.69%. That doesn't, I'm leaving out the cash, that's the premium dollars that went towards fees and expenses and everything else. So this person at age 65, before they retired, had $1.7 million of cash value in their account. And they were able to generate $128,000 of after-tax income per year from their policy for the rest of their lives. So what does that work out to be? So if you were to take the $128,000 and divide that by 1,716,621, you'll find that that works out to be about 7.5%. So right between the 7 and 8% that I quoted earlier. So what everybody usually says at this point is, well, life insurance isn't going to grow as fast as I can grow my money in whatever mutual fund that I pick. It can be XYZ mutual fund. Let's just say they think they can grow it at 8 or 9% per year. If life insurance is only growing at, in my assumption here, 5.69%, clearly you're going to have more income, or clearly you're going to have more assets accumulated by the time you retire. But as I just showed you, is that going to be enough to overcome the 2 to 3 time income, that 8% withdrawal rate or income rate that you can get from life insurance? So now let's take a look at some real numbers, more of an A-B comparison, where I'm looking at the same amount of money going into life insurance as going into an investment. So in this example, I believe these are the same numbers that we just looked at off the illustration. So under the header of life insurance, you can see the $45,000 a year being put into premium for 10 years. And you can see the resulting cash value just off to the right side of that. So on the $45,000 of premium, you can see that the end of year cash value with the first year's growth included is $41,533. And this client is age 36, so on the young side. The alternative is that they're putting $45,000 into an investment that we're assuming is growing at 9% for this scenario, and we're reinvesting all of the profits. So I just wanted to stop at this point and explain, there's multiple ways of looking at this. That money may be going into a traditional IRA where the person would be getting a tax deduction on the money going in, and it would grow tax-free, but then they would pay ordinary income tax when they take it out. Alternatively, it could be a Roth IRA, which is much more comparable to this, where you're paying taxes on the money that you're putting into the savings plan, but then it's growing tax-free and you can access it tax-free. That's the same as the way that life insurance works. Or alternatively, you can put it into a brokerage account where you're spending after-tax dollars and it's growing and you're paying capital gains and dividend taxes ordinary income taxes on the dividends that you have as the money's growing. So not all of the growth is being reinvested because of the tax impact. So that's what we're looking at here because it's the easiest to model. But this tool would be easy enough to modify in order to analyze how it would look for a Roth or a traditional IRA model. So as you can see here, the numbers are here so that you know that I'm doing the calculations, but I want to show you that this is what is backing up the next chart, which is just simply a comparison of A versus B graphed out over time. And as you might expect, the assets in the traditional, or not traditional, but the brokerage account are outperforming because it's growing at 9%. And life insurance is only assumed to be, the cash value is only assumed to be growing at 5.69%. But you've got a little bit of a tax advantage because not all of that 9% of growth is being reinvested because some of that is dividend income and some of it is capital gains taxes. So again, this is the accumulation. And this is where a lot of the gurus stop with their analysis. So like guys like Dave Ramsey, I don't know if you've ever heard of the white coat investor. He's, a lot of times if you're searching for investment information, you'll find his site. And they will poo-poo the idea of life insurance because they know that you can grow, you can accumulate so much more wealth by growing your money in a traditional asset that makes 9 or 10% per year. But that number is just a number on a piece of paper. So let's take Morgan Stanley, for example. Morgan Stanley is going to send you a statement every quarter of how much money you have in your account. And it could be spread out across different stocks, bonds, mutual funds. But it's just a number on a piece of paper. It doesn't put food on the table. It doesn't pay the light bill. So at the end of the day, what is important is how much income you can get from your savings. And that's what we're going to look at on this next chart. Income is what matters. So here I've taken the accumulation from the previous chart and that table that I showed you, and we're converting it to income. So if we use the standard 4% rule, that's illustrated by the blue line. So the way that you interpret this is if you retire at any particular age, this is showing you how much money you could take for the rest of your life. So if you retired at age 65, for example, you should get somewhere around $75,000, $80,000 a year for the rest of your life. If you put off retirement until 70, you might be able to take $100,000 a year for the rest of your life. All right, so hopefully you're clear on how the chart works. But what's really important to understand is on the orange line, which shows the income that you can get from the cash value of a life insurance policy, you can see that it's almost twice as much income across the board. So that same person at age 65, where having money in a traditional brokerage account may have given them $75,000 a year, according to the 4% rule. Now they're looking at something in the neighborhood of $125,000 to $130,000 a year. Or if they put off retirement age until 70, instead of having $100,000 a year of income for the rest of their life, they're looking at something closer to $175,000, $180,000 a year for the rest of their lives. So clearly, a maximum overfunded cash value life insurance policy has the potential to provide much more retirement income than what you can get by putting the same amount of money or savings away every year into some other asset class. So hopefully I've debunked the idea that life insurance is not an investment. It's not an investment, but who cares what you call it, so long as it accomplishes your investment objectives. And if your investment objective was to save towards retirement and have retirement income, clearly this is a very powerful tool for you to include in your retirement planning. All right, so lastly, I want to talk about some of the advantages of using life insurance, or specifically a maximum overfunded cash value life insurance policy as an asset for generating retirement income. Or almost think of it in terms of as an investment. So the first thing to be aware of is that life insurance offers principal protection. So unlike a lot of Wall Street investments, clearly stocks and bonds to a lesser degree do not offer principal protection. Bond prices fluctuate on the basis of underlying interest rates. So that brings up another advantage of life insurance, which is that you're not subject to interest rate risk like you are with bonds that you would buy in the market. The best way to think of interest rate risk is if you buy a bond with a 5% coupon and interest rates are high, as interest rates go down, other people will pay extra to get your bond because of the higher coupon that it's offering. So bond prices rise whenever interest rates fall. But conversely, and think about where we are today, and I know this video is going to be out for a long time, but today's interest rates are at historic lows, and they have really hopefully nowhere to go but up. So bond prices are going to take a hit as interest rates rise and people can get more and more new bonds with higher interest rates. Why would you buy a bond with a lower rate from a couple of years ago? So the advantage that insurance companies have is that they hold bonds to maturity because they're not investing to trade the bond itself like a lot of bond funds do, but they're trying to meet their financial objectives and liabilities that they have, 20, 30, 40 years out into the future. So they have no incentive to buy and sell bonds unless they haven't had a need to for liquidity purposes. And liquidity purposes brings up another advantage of life insurance, which is that because the insurance companies are buying bonds and holding them for long run periods, they are capturing a little bit higher interest rates than most people. There's a trade-off. If you want liquidity and get your money out, they're not going to offer as high of an interest rate for you. But with life insurance, you get the ability to capture that long run interest rate or return, but at the same time you've got liquidity in the form of being able to access your policy's cash value via a policy loan. So these are all powerful advantages in favor of life insurance as a tool. Now, as far as returns go, your basic whole life is going to offer return on par with the bond markets. Maybe even a little bit better, only because they are holding it for a long run and capturing longer run interest rates. But an indexed universal life, on the other hand, is going to capture a premium over that debt market rate of return. So the best way to understand an indexed universal life is that the insurance company is taking the dividend that they would have credited to your life insurance policy, and they're taking that money instead and going to the index options markets with the goal of hedging with options to capture as much movement in the market index as they can get with the money that they have. And they wouldn't do that if they couldn't capture a little bit higher interest rate over time, or annualized rate of return over time. So typically, the numbers that I've analyzed, I've seen typically a 2% premium over the typical debt market at any given time. That positions an index universal life as being somewhere between the bond market return that you could achieve and something that you could get with the equity market return, higher expected return, but also higher risk. So the number one takeaway that I want you to get as far as the advantages of life insurance over a traditional investment class is that you can get 2 to 3 times the income from the same amount of money. And that's the main takeaway that I want everybody to grasp and understand here. All right, so wrapping up, again, my main point here is that it doesn't matter what you call it. An investment, call it life insurance, call it investment, but if it furthers your investment objectives, then it doesn't matter what you call it. A maximum overfunded life insurance policy belongs in your retirement planning portfolio as an asset class that you should include in your planning. So with that, I'm done. If you'd like more information without having to talk to a life insurance agent, I highly recommend going out to Facebook and joining my Double Play group. I'll put a link in the description below for that, but the Double Play group is a forum for my clients and anybody who's interested in this concept to ask questions of people who are actually using life insurance to invest in real estate, and they can give you unbiased opinions without talking to someone who's actually selling it. So I highly recommend going out to Facebook and looking for the Double Play group. Otherwise, if you'd like more information, I do weekly, or I haven't done a weekly one in a long time. I do monthly webinars now. You can sign up for those on my website. Much of it is the same content as this. It's just going to be much more current because it takes me a while to get these videos produced and out there. And then, of course, there's my website, innovativeretirementstrategies.com, which I consider to be a no-fluff zone. So you can go there and find blogs and articles that cover all of this same information. And again, you can get all the information you need without ever talking to an agent. It's just that whenever you're ready to see an illustration and see what this looks like for you, then you need to give me a call. But with that, I'll see you in the next video. Be sure to like and subscribe.